It is 9:30 opening bell, April 14th. Let's get started. First things first, we understand risk in trading. Please and always use trade capital only. Do not trade with money you can't afford to lose, whether trading stocks, options, futures, forex, cryptos, whatever asset class you're trading, you know the risks. Social media, make sure it's a real me. I saw quite a few emails this week, whether it's Telegram, Facebook, Instagram. These are my handles. These are the only handles that I look at, monitor, and manage. So, best way to find me is here Mondays and Fridays for the YouTube channel, Pulver Report, youtube.com/Chris Pulver. Facebook is facebook.com/Real Chris Pulver, and Instagram, Twitter handles also same at Real Chris Pulver. All right, let's jump into the charts. Opening bell, we're sitting at 413 for the SPY. So far for the week, we're up a little bit. Still haven't broken the highs back here in February, and we still haven't broken the highs back in August. So big data this week that the market digested. We had Wednesday CPI news, which actually was a pretty dramatic drop. So 6% year over year was the previous, came in 5%. Core CPI, which excludes your food and energy costs, came in as expected at 0.4, which is a slight, tick lower. So inflation data for the most part was pretty positive this week. I expected the CME watch tool for the Fed in May to change. It did a little bit, but the probability is still edged towards raising rates one final time. We had Fed speakers kind of reiterating this and reaffirming this all week. We also had core PPI numbers coming in, which were, again, it's interesting because years ago, you don't want to see red in these areas, but now you do. So unemployment claims were higher, so that's good. Possibly a little cooling of the job market, but prices are coming down. Inflation data coming down. But like I said, here's the CME watch tool. We go to the browser here, CME watch tool. It was like 60-40 yesterday, and now it's back up to 80-20. So Fed is still looking to raise rates. That's probably just because of the Fed speakers this week. I think we had Bullard, we had Bostic, we had a handful this week that were just all talking about one more rate might be appropriate. But I think the market's also forecasting rate cuts coming in later this, Q3, Q4. Now, it's very possible that this rate hike might concern investors for the Fed might force the market into, or force the economy rather, into a recession. I mean, if you don't feel like we've been in a recession for the last year, then I don't think you've been paying much attention. It's certainly, as Main Street, it feels like one. We show the data that it is one, essentially, contracting GDPs and whatnot. And growth-wise, I mean, we're looking at essentially, U.S. growth is slowing, global growth is slowing. Forecasts have been cut across the board. There's very conservative guidance going forward in the corporate world and on Wall Street. So anyway, a final rate hike is fine, but at some point, if the rate hike happens and that's a pause for the next couple of months, is that what puts us into a recession? Are we raising rates and then we have the whole debt ceiling coming through the summer where that gets things a little bit dramatic and juicy from July to September? I don't know. And then we start cutting rates later on. So it doesn't mean that it's just crystal clear blue skies ahead. But for the most part, we've had a pretty decent melt up. The markets are up off the lows, and we will see if these highs get broken or we just start going back and forth. Let me bring up a drawing tool. I mean, we could certainly just fade back down and maybe have some range bound trading with slow growth. We've had the big tech leading the way, but if we don't take out this high, do we just do this, right? Do we go sideways for a little bit as we approach? I mean, I thought we'd have a little bit more of a determining move coming into April, middle of April, getting some of this data out. We have a runway until May 3rd. So we're not done. We could just have a melt up, but the high's right here back in February of this year. Take a look at the Qs. Index-wise, Qs are up more than any. Qs are up well off the lows. I mean, about 20% or so. So off of this low to start the end of last year and right at the beginning of this year, we're sitting around 22% off the lows. So again, hasn't broken the high in August of last year, hasn't broken the low in October. Are we going to clear this hurdle? I talked about it on Monday. If we do, there's not much stopping that. We took a look this week in the trading room. I kind of pivoted into looking at some fixed income vehicles just to show what all the fuss has been about. This 2 and 10 year. It's like this 10 and 2 year. So our inverted yield curve that's been so bad and so deep and one of the worst, or I should say the deepest we've had since, get out of here. Well, you can see it. Um, since 1986 or 1987, when we had basically a peak rate in March. We had the peak inverted yield curve in March as well. Since then, we've had a big shift in basis points. We still have an inverted yield curve at negative 0.51%. So I mean, I am playing some short-term bonds, some short-term treasury bills, some 6-month, 12-month CDs, money market instruments, some fixed income vehicles for some safety, but also investing like crazy. So anyway, that's that. Let me log into the YouTube channel, say hi to everybody. We'll take a look at some charts. I'll take a look at see how the robots did this week. Log into the YouTube. Close that. Okay. So Gary, good morning. Don, good morning. Andrew, what's happening? Good morning, Catherine. Jason, tax day tomorrow. Yeah, that's true. Happy tax day. I thought there was some extensions around the country, like the 18th, or even out to maybe certain states were allowing some extensions. But yep, tax day tomorrow. I did mine about a month ago, so which was good. Happy that I just got out of the way. Robert, what's happening? Donna, good morning. Ranjit, good morning. David, good morning. The 18th, yeah, the 18th. Okay, so they're due. Is that Monday? 15th, 16th. That's Tuesday next week. Okay, well, get them in. All right, good stuff. Nice to see everybody. Happy Friday. All right, let me take a look and see how the robots did this week. Perfect Storm. How did we do this week on Perfect Storm? 485 pips on Perfect Storm. Okie dokie. I'll certainly take that. How about the Perfect Storm Pro? Right here. 234 pips. And Pockets Pattern Pro. And I'm going to start tracking my Equalizer Pro as well. Pockets Pattern Pro up 190 pips. So not a bad week. Not a bad week. We had a pretty active week in some Forex. We've seen a weaker dollar. Currency strength chart. Here's what's happening for today. Pretty quiet volatility-wise. Dollar and CAD on top, but you know the dollar's been beat up pretty badly all week. I had a chart alarm go off on the DXY overnight, 100.80, and that's equal lows. So we have talked about the structure in the dollar. If this is high to low, we might have a pullback on the dollar here before the dollar goes lower. Right? So if we hold right here on the dollar, then we may see this pull back. Okay? If we break lower, then that's why we have this large Fibonacci swing, because we have high to low, a shallow pullback. We might push a little bit lower, find this 1.8 to 127 zone, and then start working our way back up into this swing boundary. All right? So it's either going to hold here and be near term bullish, but it's rare to find a bottom or top in the middle of April. That's usually not the case. So I wouldn't be surprised if the dollar just remains under pressure, starts to come into this level here, and then we start to see some lows forming. There's some big levels of past support and previous resistance around 95.77 on the DXY. So that might be enough to push it back up into this area, find this low, maybe come back up into this boundary like I said. But we'll see. We'll see. And we took a couple of trades on the basket. So the euro dollar is we had highs around 110.70. We put in a little buy trade. We got it scaled. We're scaling in, but we have a stop loss around 108.50. Pound dollar, same thing. We put a stop loss below this recent low. Aussie dollar, we're getting long. Stop loss about halfway through this little channel that we've had. New Zealand dollar long. Dollar Swiss, I'm holding long. This has been one of the worst performers as far as like holding dollar Swiss long. This one has dropped back down to pretty substantial support back here in 2021. But I'm still holding. So I did add a position back at 9,000. My next big level here, they're marked out 85.60 and 82.50. Those are big levels I'm going to mark. And this looks pretty similar to the DXY. If we have a fresh low, we might work our way back up in this area, right? We have a big swing. Or this just settles in, gets more extreme, oversold conditions, and then we start working our way back up into some of these pockets and inefficiencies. We still have a pivot. We still have a massive pocket, and dollar Swiss is positive swap. So I'm going to hold dollar Swiss long and just dollar cost average into it. And also, this is like a 10-plus year range. So I'm going to stick with it. Stocks this week, I've got some expirations. 414. Let me take a look. 414. Should have some stocks looking pretty good. Let's see here. Coinbase, that'll be full profit. Microsoft, that'll be full profit. Microsoft, that'll be full profit. I think I have a couple of metas in there as well for full profit. There's Coinbase. DIA, that'll be full profit. Well above that. Microsoft and Meta, full profit. And then Tesla, I have some out of the money bull put spreads. Actually, I've got a bear call spread and a bull put spread. Tesla's trading at Coinbase at 71. Okay, very good. We're trading at 184. So I need Tesla to get a little bit of a nudge going into next week. I have basically it's a reverse iron condor if you want to get fancy with it, or I just basically put in a bull put spread in the upside and a bear call spread in the downside. I need price to get above 190 or get below 175. If I can do that, then I walk away with 65 cents profit. If it stays in the middle, then I'll probably manage these for a small loss. I've already rolled this once from March to April, but we're going to see. So if I can get one to pay out 65 cents, if the price comes back up near 90, I might just manage the winning side for partial profit and close it out early, and then just close the losing side. And as long as I can get some net profit out of it, they'll be fine. But hopefully we don't just stay right here at 184. That's kind of the worst case scenario for me, is just right in the middle. So I will see how that plays out, but hopefully we get a nudge in this next week. I just got a chart alarm on Coinbase, so that's good. We're trading at 71 and change right now. We have not gotten up this past week, and really most of the month. We had a gap on Coinbase, but we're not able to clear the 72.50 handle. We've had a pretty decent run on Bitcoin. Bitcoin's trading with fresh highs nearly at 31,000. Ethereum had a run to the yearly pivot finally and hit 2,000 plus. So Ethereum is at 2,100 plus and running strong. The last level of big support back here at 2174. We've already played this symmetry swing out to 2307. So there's some good upside potential, buying dips, and I'm sure that any crypto holders pretty happy about this recent run. And there's a pretty decent argument to be made that so far, Bitcoin's doing pretty well. It's performing well. It's up like I think 60+% off the lows for the year. That is up around, I take that back, I stand corrected, 90% off the lows. Nothing like having crypto shine for right now. 30K is a big level. Past support, a lot of chop. If we can stay above 30,000, I think this becomes a bit of a floor. There is a lot of upside potential. I'm not saying I'm super bullish on it yet. I think price still has to prove it. But if we can hold here and pause here, breakout looks pretty good. Right? So, I mean, if we get a pullback, that's fine. I mean, a pullback, I'd still be interested in buying dips. My concern is that if it turns now, we come back to 20K and we just range. And this is, looking better, but we also might see a lower period of range trading. Okay? So we'll see how that plays out. But overall, if you're holding any crypto or Bitcoin or Ethereum, they've been doing pretty darn good. And that is exciting. If we go to coin market cap, let's see where the thing has improved. This is total market cap by crypto. Let me take a look at the total. We're now sitting at 1.27 trillion. And we're well off the 3 trillion plus highs. But if I zoom in here. So it's interesting. I mean, the market cap is going up, but we're not really seeing sellers. There's an absence of sellers. It's just an asset. It's just providing some gains right now. We're a long ways away from nearly 3 trillion in market cap, but gains are gains. If you're holding and you bought with me back at 20K, or you start dollar cost averaging into the levels we talked about, we were basically buying on the way down at 25 and 20. We should have been buying at 17.5. I had 18, 15, and 10.5. So I got filled on 18. I didn't get filled on 15 or 10.5, but then I added again on the dip at 20. So all in all, built a pretty low position, which is looking good, and hopefully to the upside, we're maybe celebrating a new high later this year. If that's the case, that'll be an exciting run that I'm sure will create some bubble-ish trading once again, but maybe this time it's serious. It's still a trade. If this thing runs to, I mean, look at this channel high. I mean, I think technically there's going to be some obedience here, but if we have a run that structure up there, I mean, we're looking at 80,000. I'd say 100K is probably a large milestone as well, maybe a psychological number for before there's some pretty heavy profit taking. So it's going to be interesting how it plays out. So that's a little Bitcoin action. Any stocks, any charts you want to take a look at market wise right now? 414 in the SPY, so we're up to a pretty good start. 3/10, 1% higher right away. The DIA pushing a little bit higher as well. I was taking a look at the IWM. That's the ETF for the Russell. So we're off the lows. We didn't hit this major support. We're hanging in there. There's some supply levels we can pull back to, little small cap gains, but for the most part we're still led by tech. If we go, I think it's XLK. XLK's technology. This is one of the best performing sectors of the year so far. And take a look at where we started. This looks an awful lot like the Qs. So XLK, there's your low, there's your price. It's around, so the Qs are up 22%. Let's see what XLK is up. It's up around 24%. So Qs are also heavily weighted with market cap. A lot of it is, what did we talk about? Was it Meta and Microsoft? Or Apple? No, Apple and Microsoft. Those two companies alone make up like 25% of the QQQ. So it's very heavy in the FANG stocks. It's not necessarily FANG any longer because it's Meta, not Facebook, but you get it. Big tech kind of leading the way. So, but it's, I mean, certainly nice to see it's different than last year. Last year was just every rally's a sell, so much fear and uncertainty. And this year we've kind of turned the corner. We know where the Fed is likely going to be. They're likely not raising any rates further. It may be, and again, it's 80-20 right now, but this can certainly change over the next 2-3 weeks. I don't think they're. I mean, I think they just do it. Just do what you say. And if you're going to cut rates later, fine. We still have to tackle the debt ceiling stuff this summer. We'll see how that plays out if that becomes dramatic for the markets. Is this enough to allow the markets to continue to melt up and recover? I mean, what's crazy is we talked about this weekend in the Flex Trading Room and Equities on Demand. I mean, off the lows, the market's up 22% already, right? So are we able to increase that again? Are we able to double that? The first quarter of the year essentially. Are we able to double that by the end of the year? Be up to nearly the highs again? That would be one of the largest years we've had on a year-to-year gain. So I don't think that the market necessarily comes out 40% up, but I think that 20 to 30% is very much in the cards. I think it's possible as long as we don't have something that's going to really crush it. So what do we have here? Bear call spread. I think that's out to next week. And those bear call spreads are jabs, but we have obviously mostly bullish on our positions and things are going pretty well. So we took a trade this week in LTHM. We actually bought it at $21.45 and did some credit spreads. We're actually in profit on everything now, $22 and $22.50. I actually did buy some shares at $21.55, and I threw in a $21 call for next month that paid like $1.80 or $1.85. So I'll make a couple bucks on that LTHM if it stays above $21 by May. Credit spreads are staggered out through January of next year, and there's a nice little 50% window from this current level. If we maintain this support and start pushing higher, get back to the midpoint, or hit this high at 33, that's a 40 to 50% upside. So I do like this stock structure wise. There's quite a few stocks that are looking pretty good. If we get some runs on JetBlue, I mean, I like the pricing on JetBlue. I like the pricing on Under Armour. Just really buying off of 2020 lows or buying off of, COVID lows, 2020 lows, 2008 lows, any levels like that. I'm trying to think what other ones are looking pretty good. We've got some mining stocks doing pretty well. 1204 on MARA. GBTC is a Bitcoin-based ETF that's up to 1803. Again, really nice run off the lows. We had lows here around $7 and change. Now we're up to $18 and change. Right up to that yearly pivot. There's still gaps higher. Yeah. So, I mean, all in all, call it a melt up. Call it whatever you want. But there's a kind of a free and clear time runway until the Fed in May. Right now, it's still showing that the Fed is likely to raise rates 25 basis points. It's kind of that final hurrah. So we have the raise and we have the pause. And then, of course, the market's very interested to see or hear, is the Fed going to start cutting rates? The Fed has said very little about cutting rates. I mean, in fact, Jerome Powell in his press conference in March was talking about, no participants are talking about cutting rates this year, but the market says otherwise, right? this watch tool says otherwise, that we're cutting by 75, 50 to 75 basis points later this year. And again, what we don't know is, are we cutting, or are we anticipating the rates being cut by the Fed because of a recession? And remember, I mean, for the last like 10 recessions or 11 recessions, I think 6 times the markets have finished higher. So it's kind of 50-50, but we look back historically, I mean, we're kind of in this interesting environment where we're off the lows. A recession may not really drag everything back to crazy lows. We might just be sitting, here and just struggle to make dramatically higher highs. Or maybe this is just a weird situation where it's like, you know what? It just does. And I talked about it this week. I mean, maybe the reason we see the market rally this year is because less people are participating. And the reason people are participating is they got scared out of the markets last year, so they went into fixed income. So I mean, the amount of applications for money market instruments and fixed income vehicles, and I'm sure Treasury bill auctions are probably as high volume as they've ever been. Um, and I just wonder if that means that we just have more of a melt up where there's an absence of sellers. There's still forced buyers, monthly, but also it's just nobody's really bearish, you know. And if anything, those holders from last year, just holding positions, are recovering for the most part. So, yep, that's right, Catherine. That's a good point. Their earnings stay on bank stocks. So I'm not sure if they're before market or after market. Tesla, Schwab. Oh, Tesla. What? Oh, 419. So that's next week. Okay. Schwab, Investment Bank, Johnson & Johnson, TMC. Let's go to today. Okay, so I think the check marks means we already had them. I can double check that. So JP Morgan was decent. Citi, Wells Fargo. We can click on these. Let's go JP Morgan. So we had pre-market. Yep. So it was before market open. Everything good on JP Morgan. I mean, that's good. And what we should understand is, these are also huge banks that are reporting. I'm sure they've had a pretty good inflow since, people have been jumping out of regional banks and kind of middlemen banks. I was talking this week about those fixed income vehicles. If I want to do a bank CD, I mean, if you know your credit union really well, maybe a credit union. But I would say, just to be on the safe side as an investor, I mean, too big to fail makes me feel a little bit better. So I went with the Goldman Sachs 12-month CD this week, and I went with the JP Morgan. It's a 5% 12-month CD. It's like, that's pretty good in a tax-free account. It's like, I don't have to worry about it. Let it come to maturity. Let it go for a year, and it's good. So anyway, these are all pretty big banks. Citigroup, Wells Fargo, JP Morgan. I don't know if there's some after market today, or if we report early next week. Let's go to Monday the 17th. Schwab, State Street. State Street, that's MTB Bank, M&T Bank. Tuesday. I think we have a lot more. Bank of America is on Tuesday of next week. Goldman Sachs Tuesday next week. Bank of New York. That's a Bank of New York Mellon. Yeah, so we still have some financials kicking off earnings season, which will basically take us into the end of April and middle of May. So we're heating up once again for some decent volatility, and if things look better, then guess what? I mean, earnings and interest rates, right? So if interest rates are, and remember, you have to remember that the markets are forward thinking. So if the markets are looking ahead, thinking that, look, right now we've already hit our peak Fed funds rate, and over the next 6 to 8 months, the market's expecting rate cuts, that might fuel some growth. If earnings come in solid or stable, that might fuel some growth. So, I mean, right now I'm looking at, I mean, we did a lot of neutral positions this week that were staggered out through September, October, November, December, January of next year. I just think that we're probably not going to stay here. We're either going to be higher, or if we go lower, that's fine. But I would say I'm probably like 70-30 favoring the bulls right now at this stage. So, but I think that the most important thing is, whatever you're doing long, you want to have something that helps you on the downside. You want to protect anything that goes against us. So credit spreads are good. Having a long dated long put on any stocks you own is good, just to make sure you can stay stay protected and ride any downside. Let me take a look at Pfizer. I got a covered call on Pfizer, trading at 41.48. Okay, Intel, got a covered call on this one as well, trading at 32. All right, so still got some good stocks running there. Okay, so I'm going to switch gears here to equities on demand. I got class in 2 minutes. Any questions for me? Just a little recap, a little review for the week. Overall, pretty good. I've got some expirations for full profit today. That's always making me happy. Forex wise, robots did pretty well this week. One more thing before I go, I want to show this. I'm pretty excited about this right here. These are two separate deployments. Okay, this is a sell-only deployment. This is a class that I'm teaching later on today at 2:30 p.m. Eastern time. This is a bonus strategy that I put together. I was going to talk about this today at 2 o'clock. So if you're in my Equalizer Pro class, we're going to talk about this this afternoon. This is a sell-only deployment, 28 currency pairs, and you know, a 16% drawdown is the sell side, a 28% drawdown on the buy side. That's with a $5,000 account. Now I can take that. I could probably cut that in a quarter. So I could take a 60% drawdown and probably cut that by 12%. How do I do that? Well, I can trade less levels, which let's say I trade. Well, let's break this down easy first. Number one, I could have a larger account. This was a $5,000 account. Okay, so if I started with a 10K account, this automatically gets cut in half. So there's an 8% drawdown. Okay, if I want to cut that in half, rather than taking 6 levels, I take 3 levels, and that cuts that in half again. So just with 2 little adjustments with how this is deployed, you can go to a single digit drawdown. Now, granted, you cut the level of entries, then you're going to cut your profits as well. But if drawdown is important, which it should be, especially for traders out there that have strict rules like a funded trader account where you can't have a floating 10, 12, 50% drawdown. You have to have like an 8 to 10% tops. We can do that by using good risk management. But nevertheless, it's a silky smooth equity curve, and I put this through. I told traders in the class I'm going to do this. I put this through a wild environment. I put this through 2015's flash crash from the Swiss National Bank. I put this through Brexit in 2016. I put this through the oil crisis in 2018 and 2020 with COVID as well. I put this through the melt up in 2021 and the tech reset in 2022 to present. So this traded full auto January to December, 28 currency pairs, 2015 all the way to the end of March of this year. So that's 8 years of testing. And the numbers look pretty solid. Return wise, we're averaging about 26% a year. Pretty happy with that for something full auto trading all the time. And this is a sell only, and I have another one here that is a buy only. I'm going to change the name of this. This one, I've got sell. See it? They're two different ones, right? So I've got sell only. I need to edit this one. This is quick pips. This is buy only. There we go. So I'll save this one. There we go. So you'll see 2 different deployments, but pretty silky smooth. And this one, like I said, this one's short and profitable, and this one is long and profitable. So it really doesn't matter what direction you traded, but like I said with this initial strategy, I want it to trade what it's best at. So when I put it for a buy only, it's only going to buy and manage buy trades. When I put it for sell only, it's only going to sell, manage sell trades, not try to do both. I don't want to get stuck back and forth between should it be buying, should it be selling. I just want it to do one thing. And that approach is proving to be pretty fruitful. So I'm excited to talk about that in class today. Yep, Patricia. Yeah, and that's why. So, especially for the prop trader stuff, I know that drawdowns and risk management is really important. So it's pretty easy to do just a couple of tweaks. We can just modify the levels we trade, and we start out with that 10K account balance, and we cut those drawdowns down quite a bit. Also, we have funded trader accounts that are up to as much, I think, as 25K for the first tier. So it helps. So, all right, it's just after 10 o'clock. I got to switch gears, jump into the trading room. If you do me a favor before you go, we have a decent group watching. Everyone's taking a look at this on the recording as well later on today. That's fine. If you do me a favor, hit the thumbs up button for me. Let's try to get as many thumbs up as we have watchers. And that's it. Happy Friday. Happy trading. Lots of profits. Thanks for being with me this week. And I'll be back on Monday. Thanks, everybody. Bye.